Right now, somewhere, a housing market is quietly losing its ability to absorb bad news. Not collapsing, not crashing, just becoming slower to recover from small shocks than it used to be, a subtle change in behavior that shows up in the data years before anyone notices prices actually falling. Let's be completely honest with you before we go any further. The same way we've tried to be honest in every video on this channel. No physics law, no equation, no formula on earth can tell you the exact date a housing market will crash. Anyone promising you that specific a prediction is selling something, that claim would be scientifically dishonest, and this channel doesn't do that. But here's what physics genuinely can tell you, and it's more interesting than a fake prediction anyway. It can identify when a housing market is becoming slow, noisy, highly interconnected, and vulnerable to a sudden change in behavior. There's a real name for this condition, borrowed directly from physics and ecology. And once you understand it, you'll never look at a stable housing market quite the same way again. It's called critical slowing down. Let's get into exactly what that means. Here's a single sentence this entire video is built around, and it's worth writing down if you're the type of person who takes notes. The hidden law of housing crashes isn't that prices are high, it's that the market's restoring forces become weaker than its self reinforcing forces. A healthy market, when pushes back, small shocks get absorbed, prices stabilize, buyers and sellers adjust and move on. A fragile market, when pushed, doesn't push back the same way anymore. Instead, small shocks start getting amplified, echoing outward instead of dying down. That's the real distinction between a housing market that's simply expensive and a housing market that's genuinely dangerous. Price alone was never the warning sign everyone assumed it was. The warning sign is something quieter and considerably harder to notice if you are only watching the headline price. Let's build this concept from the ground up because it's genuinely one of the most elegant ideas in all of complex systems physics, and it applies far beyond housing. In physics and ecology, a system becomes measurably slower to recover from small disturbances as it approaches a tipping point. A lake that's been slowly polluted may take longer and longer to return to its normal healthy state after each new disturbance, right before it flips into a completely different degraded ecological state. A magnetic material can become genuinely unstable, showing subtle warning signs before it suddenly changes phase entirely. Financial markets, including housing markets, can show the exact same signature before a crash. In a stable housing market, a small rise in mortgage rates causes a temporary dip in demand. Buyers and sellers adjust, and prices stabilize relatively quickly the way they are supposed to. But near a dangerous threshold, something changes. A small shock takes measurably longer to disappear. Price volatility increases. Price movements across different properties and regions become more correlated with each other. Market participants increasingly start copying one another's behavior instead of making independent decisions. And crucially, a genuinely minor disturbance becomes capable of producing a large, sometimes irreversible decline. Mathematically, this idea can be captured with a deceptively simple model. X sub t plus 1 equals A times x sub t plus epsilon sub t. Here, x represents how far the market has deviated from its normal condition at any given moment. A measures how strongly the system remembers its previous state, and epsilon represents a random shock hitting the system as it approaches 1. Something genuinely dangerous starts happening. Recovery becomes measurably slower. Autocorrelation rises, variance rises, and the entire system becomes progressively more fragile. That single parameter, quietly creeping toward 1, is the mathematical fingerprint of critical slowing down. Here's where this stops being theoretical and becomes something researchers have actually gone looking for, and found research examining the US housing market has identified genuine early warning signals of critical transitions embedded in housing permits, sales volume, and the proportion of homes sold for a gain, measurable trackable statistics, not abstract theory. These signals reportedly appeared before both the 2003 to 2004 subprime transition and the larger 2007 to 2008 crisis that followed it. That's a genuinely remarkable finding. It means the mathematical fingerprint of critical slowing down wasn't just a clever theoretical framework applied after the fact. It showed up measurably in ordinary housing market statistics years before the crisis that made those years famous. The system was quietly losing its ability to absorb shocks well before anyone watching the headline price numbers noticed anything was wrong. Now let's get to a mechanism that's considerably less well known than high prices plus high interest rates. The actual nonlinear mathematics hiding underneath house prices themselves. A simplified asset pricing equation for housing looks like this: P sub t equals R sub t divided by the quantity I sub t plus pi minus G sub t. In plain language, the price of a house equals its rental income divided by a combination of the real interest rate, a risk premium, and expected future rent growth. Here's the part that matters enormously and gets missed constantly in casual housing commentary. That denominator can become very small when interest rates are extremely low, and when a denominator gets small, the entire fraction becomes hypersensitive. Even a modest change in interest rates can produce a wildly disproportionate change in the theoretical value of the house sitting on top of it. Research from the European Central Bank found something genuinely striking. When real interest rates are already extremely low, a rise of just one tenth of a single percentage point could exert downward pressure of roughly 1.1 to 2.3% on real house prices in their euro area estimates, something like 3 to 8 times larger than what conventional models had suggested. Housing bubbles don't become dangerous merely because prices are high. They become dangerous when the mathematical denominator quietly supporting those prices becomes dangerously thin. Here's the mechanism that turns a fragile market into an actual crash, and it's genuinely a self reinforcing loop, not an ordinary supply and demand story. Cheap credit increases how much people can borrow. Greater borrowing capacity pushes house prices higher. Rising prices increase the value of the collateral backing existing loans. Higher collateral values let people borrow even more against that same property. More borrowing creates additional demand. Additional demand pushes prices higher still. At some point in this cycle, buyers start purchasing because prices are rising, not because homes are actually affordable relative to income. That's the moment a market stops pricing shelter and starts pricing momentum. Then a small shock reverses the entire process, and the loop runs backward with startling speed. Prices fall, collateral becomes less valuable. Banks respond by reducing lending or demanding larger down payments. Buyers lose purchasing power. Transactions decline. Sellers find themselves competing for a shrinking pool of buyers. Prices fall, further defaults, and forced sales increase, adding even more downward pressure. A Federal Reserve model describes this precise interaction between falling house prices, borrower defaults, bank net worth, and reduced credit supply as a genuine amplification mechanism. Lower prices increase defaults. Defaults damage bank balance sheets. Weaker banks restrict lending. Tighter lending reduces housing demand, and reduced demand causes further price declines, completing the loop. Let's call this the collateral credit feedback loop, a considerably more precise phrase than the vague overused term housing bubble. Here's one of the most genuinely counterintuitive facts in this entire video, and it should change how you interpret a cooling housing market. House price growth itself can actually become less useful as a warning signal in the immediate run up to a crisis. Research from the Bank for International Settlements found that property price gaps, the difference between actual prices and their long run trend, perform well as an early warning roughly 2 years before a crisis. But in the final year, immediately before the crisis hits, that same signal becomes less informative, precisely because prices themselves are already starting to slow or even turn slightly negative. This creates a genuinely dangerous illusion. The market can look safer right at the exact moment it's actually becoming most dangerous, purely because the bubble is already quietly beginning to deflate. A slowing market doesn't automatically mean a safe market. Sometimes it means you are standing at the exact edge of the cliff, mistaking the flattening ground beneath your feet for solid footing. If price growth alone becomes unreliable right when you need it most, what should you actually watch instead? The stronger approach combines several signals together rather than depending on any single number. Earlier price excess relative to trend, rapid credit growth, the household debt service burden as a share of income, high loan to value ratios, weakening lending standards, rising interest rates, falling transaction volumes, and an increasing amount of time required to actually sell a property. The Bank for International Settlements found that combining credit indicators with property price gaps genuinely improves warning precision. In their analysis, these combined indicators produced a noise to signal ratio as low as 11.8%, meaning the combined signal was considerably more reliable than any single indicator watched in isolation. The researchers were careful to emphasize these indicators aren't perfect forecasts, but layering multiple, genuinely independent warning signs together produces something meaningfully more trustworthy than staring at price charts alone. Here's a comparison that reframes the entire concept of a housing crash, and it connects directly to physics in a way that goes beyond loose metaphor. A housing crash behaves more like an earthquake than an ordinary economic recession. The visible trigger is often genuinely small: a modest mortgage rate increase, a major regional employer closing, a bank quietly tightening lending standards, a geopolitical shock, a dip in investor demand, a sudden change in tax policy. But the actual damage that follows depends far more on the pressure that had already been accumulating in the system beforehand than on the size of that initial trigger. A market carrying low household debt with flexible housing supply can often absorb a shock without much drama. A market carrying highly leveraged borrowers, constrained housing supply, and speculative price expectations can take that exact same size shock and amplify it into a genuine crash. This is the same underlying logic as tectonic stress along a fault line. The visible event is the earthquake itself, but the real story is the pressure that had been quietly building for years beforehand. Precisely the sandbile metaphor we explored in our video on market crashes generally, now applied specifically to housing. Researchers studying financial markets have even examined whether the disturbances following a crash follow something called Omori law like behavior, a mathematical pattern originally discovered describing earthquake aftershocks. The frequency of extreme financial movements has been found to decline following a power law pattern after a major crash rather than simply disappearing in a clean linear fashion. That earthquake framing gives us a genuinely useful lens for what happens after the initial crash itself, because the crash usually isn't the end of the story. In the aftermath of a housing crash, markets frequently experience a cascade of aftershocks: rising mortgage delinquencies, mounting bank losses, cancelled construction projects, developer bankruptcies, stress spreading into commercial real estate, falling household consumption as homeowners feel poorer, local government revenue losses from reduced property taxes, and further waves of forced sales that keep pressure on prices long after the initial decline. These aren't separate, unrelated problems. They're the housing market's version of aftershocks, the system continuing to release accumulated stress in diminishing waves, exactly the pattern the Omori law comparison predicts. Here's a genuinely surprising detail from the 2007 to 2009 US housing crisis that complicates the popular version of that story most people already believe. Research from the Federal Reserve Bank of New York found that in the states with the largest housing booms and busts, almost half of purchase mortgage originations at the very peak of the cycle were associated with real estate investors, not ordinary families buying a home to live in. These investors typically used more leverage than owner occupants and later showed meaningfully higher delinquency rates when the market turned. This genuinely complicates the popular narrative that the crisis was caused purely by ordinary families receiving irresponsibly risky mortgages. A housing bubble isn't powered only by homeowners. At the top of the cycle, investors can become the accelerant. Investors are especially destabilizing precisely because they tend to buy multiple properties at once, depend heavily on continued refinancing to sustain their strategy, treat price appreciation itself as their primary expected return rather than rental income. Sell quickly the moment momentum shifts and can suddenly flood the market with additional supply when many of them exit at exactly the same time. That combination makes the market considerably more sensitive to shifts in expectations than a simple owner occupant only story would suggest. Here's another genuinely powerful physics concept worth understanding because it explains why housing markets don't always decline the way people intuitively expect them to. A bifurcation occurs when a gradual continuous change in one underlying variable causes a system to suddenly start behaving in a qualitatively different way. In housing, that variable could be mortgage rates, loan to value ratios, overall household debt, the share of investor participation, expected future price growth, or even construction delays constraining supply. Before crossing this kind of threshold, rising prices can appear perfectly stable, gradual, and explainable. After crossing it, the exact same market can suddenly develop multiple possible price equilibria, oscillating boom and bust cycles, abrupt price declines, and genuinely self fulfilling expectations, where people buy because they expect prices to rise, which itself causes prices to rise, right up until that self fulfilling loop violently reverses. Research into nonlinear housing market dynamics has found that strong extrapolative expectations, buyers assuming recent price trends will simply continue, can destabilize a market's fundamental equilibrium through exactly this kind of bifurcation, creating multiple steady states or oscillating dynamics that a simple linear model would never predict. The market doesn't always decline gradually. It can cross a hidden boundary and become a genuinely different kind of system on the other side. Here's one final mathematical signature worth understanding, and it directly echoes something we explored in our video on market crashes. More broadly, normal market fluctuations often resemble a bell curve. Small changes happen often, and extreme changes are supposed to be rare. But housing bubbles and financial crashes can behave very differently. Extreme outcomes can follow a power law distribution instead, where genuinely massive events turn out to be far more likely than a standard bell curve model would ever suggest. Research examining land and housing prices found that the upper tail of the price distribution followed a power law pattern, and specifically that the bubble collapse mechanism was associated with the power law exponent approaching a value of 1, a mathematical signature of a system becoming genuinely unstable. In a fragile market, the probability of an extreme event doesn't decline nearly as quickly as conventional models assume. The tail of the distribution gets measurably heavier. This is precisely why housing crashes are so often underestimated by analysts who calculate risk using ordinary, everyday fluctuations. While the underlying market has quietly entered a state where extraordinary declines have become considerably more likely than the models account for. Let's come back, honestly, to the promise in this video's title, because that honesty is the entire foundation this channel is built on. Physics cannot tell us the exact day a housing market will crash. It cannot tell us the exact size of the decline or which specific city will be hit hardest. Anyone claiming that level of precision from these tools is overselling what the mathematics actually delivers. What physics genuinely can do is help identify when a market is becoming slow to recover, increasingly noisy, more tightly interconnected, and structurally vulnerable to a sudden regime change. If you wanted a single rough equation capturing the whole idea, it might look something like this. Crash vulnerability is approximately proportional to leverage multiplied by extrapolative expectations multiplied by nonlinear interest rate sensitivity multiplied by a weakening capacity to recover. Not a prediction machine, a genuine framework for understanding fragility. If you've been with this channel for a while, nearly every thread in this video should feel like it's been building toward this exact moment. The sandpile metaphor from our market crash video, stress accumulating invisibly before a trigger releases it, is the same underlying story as critical slowing down in housing, just measured through different data. The collateral credit feedback loop echoes the exact same amplification logic we explored when the Fed's interest rate signal turned out to be noisier and more consequential than its headline number suggested. And the power law tail risk here is precisely the same mathematical signature we found underneath Black Scholes, underneath market crashes generally, and now underneath housing specifically. The same equations showing up again, wearing yet another costume. So here's what I want you to actually walk away with today. A housing market doesn't become dangerous simply because prices are high. It becomes dangerous when its restoring forces, the mechanisms that normally absorb shocks and pull prices back towards stability, become weaker than its self reinforcing forces, the feedback loops that amplify every disturbance instead of dampening it. That shift shows up measurably in the data. Slower recovery from small shocks, rising volatility, increasing correlation between previously independent price movements, and a growing tendency for participants to copy each other rather than act independently. None of that tells you the exact date of the next crash, but it tells you something considerably more useful for actually protecting yourself. Whether the market you're looking at right now still has the ability to absorb bad news, or whether it's quietly losing that ability one small shock at a time. Housing markets don't usually crash because one single event suddenly destroys their value. They crash because a complex system has been pushed too far, loses its ability to absorb small shocks, and begins amplifying every disturbance instead of calming it. Physics has a name for that condition: critical slowing down. And once a market starts showing that signature, the question stops being whether a shock will eventually arrive. Shocks always eventually arrive. The real question is whether the system underneath is still strong enough to absorb one. If this kind of thinking, where physics quietly explains the parts of finance nobody else is willing to explain, is why you are here. Subscribe. New videos every week breaking down the hidden math behind money. See you in the next one.